Welcome to our special report, The Stock Market Today. My name is Jay Norris. I teach trading at Trading University. Here's a daily chart of the S&P 500. This is what folks commonly refer to as the market, the stock market. A lot of concern out there, and with good reason. You could see the market's down sharply this week. And when we see that activity, it's kind of hard not to get spooked, particularly if you have money in the market. For me, the most important question is not necessarily do I get out of my market position, but rather, is this another correction in a long line of corrections, or is this a reversal from a bull market to a bear market? In order to answer that question, we need to pan out and take a look at the big picture. Here's the monthly chart of the S&Ps. Let's go back 25 years or so. And before we analyze this, I just want to say a couple of words about my own mindset. And number one, I believe very strongly that the underlying cause of market movements are demographics, government policy, and economics. And it is these fundamental determinants that create predictable patterns that measure the strength or weakness of the market. That's my focus, those patterns in the market. Technical analysis is the study of those market patterns. Taking a look at the big picture, what stands out to me over the last 25 years is that essentially you had a secular bull market throughout the 90s. Then you had a sideways market. Now it looks like we're in another up leg, another bull market. One of the first things I learned in studying these patterns is that it's normal that markets go up and down. In fact, one rule of thumb I learned early on is that it's normal for a market to produce 50% corrections. Now, taking that rule of thumb and using it to analyze what happened here in this decade when the market went pretty much sideways, we could take the low in the late 80s and measure that up to this high in 2007, and we could see where the market bottomed out. We've drawn a channel there between the 50% and the 2/3. Now, the reason we chose 2/3 is that's straight out of Dow theory. Dow theory says that the market can retrace up to 2/3 of a primary move and still maintain that uptrend. And that's exactly what happened here in 2009. We had a nice 2/3 retracement. So, again, markets go up and down. That's what they do. 50% corrections, they're pretty much normal. Okay? The reason we're showing you this is to give you historic perspective before we can get down to the shorter term markets and analyze what's happening right now. We can see at the beginning this decade in 2013, we can see the market broke out from this consolidation range that it had been in for the previous decade. I'm going to mark the top of that range because that's important to us. Now we're going to drop down to a weekly chart. And remember, I said before, we measure the patterns in the markets to gauge the strength or weakness of that market. And you can see it's the same chart, same pattern, where you can see we broke out of that sideways range in the beginning of 2013. Drop down to a shorter term chart, a weekly chart here, so you can see a little bit more detail. 2013, very significant time period because that's when it did break out above those highs. What we're going to do is we're going to take the low of the first correction after we broke out, and we're going to measure that pattern and see where we're at now. So when you take that low following that correction, when you take the low following the breakout up to the current high in the market, you can see that you're still above that significant 50% level. In fact, you bottomed on it just yesterday, and you can see how quickly the market recovered from there. So when we go back to our original question, is this another correction in a long-term series of corrections, or is it a reversal in the market? From this perspective, you'd have to say, well, currently it's just another correction in a long line of them. Now, what's neat about technical analysis is you can go back in time and see how your analysis would have performed in the past. We can slide back here to 2007, and remember I said, is this the beginning of a new bear market or another correction? Well, We can analyze the beginning of a new bear market. This is 2007 on the futures chart. And how we gauge whether the market's a bull or a bear is essentially the pattern in the market. If you're making higher lows, higher highs, higher lows, higher highs, then it's in a bull market. Once you start to make lower lows, lower highs, then you're shifting into a bear market. That generally doesn't happen overnight. Okay, it generally takes many months, even years, for the market to move from a secular bull market to perhaps a shorter term corrective bear market. You could see that was the case in 2007. You can see these two-third retracements I have marked. The purple line is a 50% retracement. That's more of a normal retracement in a healthy market, more of oftentimes in an extended correction, you'll see it do the full two-thirds. Now, as long as it doesn't close below that two-thirds, that's okay. As long as it's closing above the two-thirds, then that market is still technically in a bull market. Now, what we saw at the end of 2007, the market actually put in a lower high. In other words, it couldn't get beyond that two-third retracement. Once it made a lower low in here, then we had a pretty good tip-off that next rally was going to be the time to exit long-term positions and even swing short in the market. That was 2007. Completely different decade, different times. Now we're coming back to today, where historically on this weekly chart we still don't have a lower low yet. Remember, in order to shift from a bull to a bear, you need a lower low first, then a lower high. Currently, you don't even have that first piece of the puzzle, that first piece in our analysis, the lower low. So given that the market this week so far has not been able to produce a historic lower low, then we have to conclude in our analysis that currently, despite the volatility in the market, despite the sharp downturn, that right now we're just seeing another correction, albeit a larger one, in a bull market. Let me drop down to the shorter term too, and I'll show you some more evidence of that. Here's the daily chart, which from our current analysis we consider somewhat short term, given we were just looking at the historic trends in the market. Now I'm going to drop down to an intraday chart. This is a 4-hour chart. I'm going to show you something interesting. Remember at the beginning I said, hey, corrections are normal. In fact, it's quite normal for a market to retrace, somewhere between 50% and two-thirds, right? When I take this, now I'm on an intraday chart. When I take this 4-hour chart and I take that low, that high right there, here, let me break it down even further to an hourly chart. And this is what professionals look at. We look at these intraday patterns to see what's going on in the market. I'm going to take yesterday's low to high. I'm going to take yesterday's low to that intraday high right there. I'm going to look at that retracement, because remember, we use those retracements to gauge the strength of the market. Look where the market bottomed. Right in that zone of support between that 50% retracement and that two-third retracement, right? So given the market's showing a tendency to bottom in that two-thirds, that's telling us that short term you have strength in that market. Once again, you had a similar pattern right here, or if you take that low to that high. So shorter term, the market's showing us that pattern of what? Shorter term, the market's showing us a pattern intraday now of a higher low. Again, a higher low. So over the last 24 hours, we're seeing normal corrections, and the market's finding support in that zone between the 50% and the 66%, and that's going to be normal. So even from a shorter term perspective, you'd have to say, well, the market's not as bad as perhaps it looked if you're reading the headlines in the news, shorter term. But pan out to the weekly chart and even longer term, it's easy to make a case longer term that, yeah, this is just a normal correction, albeit a larger correction in a long line. In a long line of corrections. So for our analysis right now, we'd have to say this is just this is just another correction in the market, perhaps a little bit exaggerated by the timing of it, It's the dog days, volume's not necessarily perhaps exaggerated by the timing of it, given the market tends to be slower during the dog days of summer. Now, I know China's been a big concern for many traders. As long as we're here, let's take a look at the Hang Seng Index and see what's going on there, because you've had a major correction in that market also. Causing a lot of traders concern there. Let's take a little bit longer term perspective. We'll pan out to a monthly chart of the Hang Seng. Here's a monthly chart of the Hang Seng. We're going to use that same analysis, understanding that it's normal for markets to go up and down, understanding that it's normal for markets to retrace, from 50% down to 2/3. And when we take a look at the Hang Seng from a historic basis, when we take the 2011 low to that most recent high, you could see that you're still between that 50% and that 2/3. So on our analysis here, it tells us as long as the Hang Seng is above the 2000 level approximately, then it's just another dip in a bull market. When you look at the historic pattern here from 2009, you have a pattern of higher highs, higher lows, higher high, higher low. So from our perspective, from our analysis, China's not a reason to panic here. In fact, the Hang Seng could be a pretty good buy opportunity also at that level if that market holds up and you see a shift of momentum back higher. My name is Jay Norris. We actually do a weekly. My name is Jay Norris. We actually do a weekly report for eSignal here on YouTube. My name is Jay Norris. We actually do a weekly report for eSignal on the financial markets, and we look forward to seeing you next time. So again, when we ask ourselves that question, so back to the U.S. stock market, when we ask ourselves that question, is it a sea change move from a bull market to a bear market? Here you can see the weekly chart. You can see the history of that market since the great breakout in 2013, that no, it's just a longer term, that we have to conclude that it's just a longer term correction in a secular bull market right now. I have to include that it's just a longer term correction lower in a secular bull market. Thank you so much, and we'll see you again over the weekend in our weekly Forex and Futures forecast. Thank you. Thanks now.